Wall Street just hit record highs, which is usually where everyone starts feeling extremely reasonable. Now comes Friday's jobs report, and the market has found a wonderfully backwards problem. If the labor data is too strong, good economic news could become bad news for expensive stocks. Yes, apparently Wall Street wants people employed, just not employed enthusiastically enough to scare the bond market. The setup starts with where markets are today. The Dow and S&P 500 both reached records on Tuesday. At the same time, oil fell sharply, easing some inflation pressure and pulling the 10-year Treasury yield toward 4.6%. That gave risk assets breathing room because lower yields reduced the pressure on long-duration valuations. But the Federal Reserve has not exactly taken a victory lap on inflation. Kansas City Fed President Jeff Schmid said tighter policy is still needed because inflation remains too high. He does not vote on the FOMC this year, but 3 officials voted for a hike at last week's meeting. So Friday's payroll report lands in a market already arguing about whether rates need to go higher again. June payroll growth was only 57,000, while June job openings slipped to about 7.36 million. That is not a collapsing labor market. It looks more like companies hiring carefully and firing carefully. The interesting part is what happens if July suddenly looks much hotter than that. A strong report can make investors think the Fed has more room and more reason to tighten. That can push Treasury yields higher, which raises the discount rate investors use to value future earnings. And when your stock price depends heavily on profits arriving years from now, higher discount rates are not adorable. That is why high multiple tech, AI names, and other duration-sensitive assets can react badly to strong macro data. Bitcoin can feel the same pressure when tighter financial conditions strengthen the dollar or drain risk appetite. But weak jobs are not automatically a gift from the market gods either. If payrolls disappoint modestly and yields fall, investors may celebrate a cleaner, soft landing path. If the data is genuinely ugly, the story can flip from rate relief to growth scare very quickly. So the market's favorite outcome is the economic version of ordering coffee at exactly the right temperature. Strong enough to avoid recession, cool enough to avoid another Fed lecture, and somehow delivered without spilling anything. That middle lane is the real setup into Friday. Watch the payroll headline, unemployment rate, wage growth, and especially the first move in Treasury yields. If jobs surprise higher and yields jump with them, the good news is bad news trade is being confirmed. If jobs cool without recession signals and yields stay contained, the record high rally gets a cleaner path forward. Wall Street got the record highs it wanted. Now it just needs the jobs report to be good, but not suspiciously good.